and happy 2024. I hope your year is off to an awesome start. I really just wanted to get in front of you today to share where the forecast is going for 2024. And more importantly though, my intent is to help share the data behind it and some strong information so that you can feel comfortable sharing this with your clients. So I'm going to dive in. I have some slides I want to share, some numbers behind it, and I want to share that with you. I'm going to share my screen. All righty. So supply and demand, that's often a big factor with most economic things, but in interest rates and where interest rates are going and in the real estate market, supply and demand is going to be probably the biggest thing that's going to impact our year right now. So let's dive in. I wanted to first share with you, if you remember, the core inflation. So inflation is going to be the biggest driver for interest rates. We're going to talk about that first. Where the Feds last year had told us that their goal was to be at 2%, and that's actually going to be PCE. So there's two factors when we're looking at inflation. But PCs, though, the Feds look at both, but when they were talking about that 2% goal, they were really focused on the PCE. So that's where our goal was. We have come down. We're right now at 3.2. So we're not quite there, but we are for sure way better than we were as we were in the middle of last year. So in December, we've been looking at this, waiting for it to get down to 2 before the Feds are going to start really kind of cutting back on that Fed's fund rate. And remember, mortgage rates aren't a direct correlation with the Fed's fund rate, but they are aligned with it. So when the Feds do increase that, it's still going to impact us, but it's more based on the forecast of where we think those are going. So the 3.2 is where we are now. And a big portion of that, of both CPI and PCE, is going to be shelter costs. And that's going to be one of the biggest things that we've seen that's going to be impacting inflation in general, and the numbers we see going forward. So shelter rents, that's going to be 44% of the CPI number, and it's 21% of the core PCE. So if you look here, you can see this line. This is where rents are or have been over the past few years. They really peaked out in the middle of 2022, if you probably remember that. But when the Feds are looking at it, they're looking at a 12-month average. Okay. So in these numbers, when they're judging PCE and CPI, they are judging based on a 1-year average of where the numbers are, and that includes shelter. So if you look here, this is the 1-year average, so shelter year over year. So you can see that it was where it started going up here and peaking. It was a lag effect to get to this point, and now it's been coming down, but again, the lag effect. So eventually these two numbers will marry up again, and that gap will be narrowed. But right now, we're still waiting on that year over year number, because you have to take the whole year average. So the lag effect here, like I was talking about, is what's impacting. But if you looked at what the real number is, this is where we really are. So as we go into the next several months, we're going to see those gaps narrowed, and CPI and PCE will be coming down because we're going to be taking those averages. So in talking about that, every month the Feds have a meeting and they release, there's two things. The CPI report is released, but then also the Feds have a meeting. But tomorrow is going to be the CPI number that will be released, January 11th. A couple weeks later is when the PCE report will come out. And again, every time those reports come out, they replace that date from the prior year. So right now, tomorrow is going to be our January our number that comes out is our December number. So from last month. So December of 23 is what will be released tomorrow, and that's going to replace the December 22 numbers. So when you look at that, we had a much higher number in December of 22 for the month over month increases. When you look at, so then when we get into the January and February, same thing, a little bit higher of numbers. We're forecasting, if you can see here, this is where they've been coming in since April of last year has been 0.4, 0.5 in this range. We did see, you know, a small increase here. A lot of that, we don't have to get into too much detail, but that was mostly short-term rentals. So that did impact that number. But overall, these numbers here have been much lower than where we were before that. So as we start to replace these numbers, so if the number tomorrow comes in lower where we're anticipating, it'll replace this number. That average for the year over year will start to come down. We're really seeing that all first quarter, we should see some big replaced numbers with these higher numbers for lower numbers. As that happens, CPI, and then when we get the PCE report also will be coming down. As those come down, the feds may be more likely to start looking at cutting rates sooner. They have already said that they're going to stop increasing. They actually threw a curveball at us when last month we thought they were waiting until the number hit 2% and that they were going to keep increasing. That's what they had said prior to, but they did change it in December and said, we're going to stop cutting, but we're not going to start, I'm sorry, we're going to stop increasing, but we're not going to stop cutting or start cutting yet. So I think as we see this first quarter happen, we're going to actually start seeing that cutting possibly happening. Now, as we get into the months after that, it's going to be less likely that we're going to see any big changes in inflation. But remember, we were at 3.2 in PCE. And as we start to see that coming down, we're probably going to be closer to that target number anyway, and we need to be there and maintain that. So expectation for inflation and the Fed cut. So here's what I wanted to talk about now. Remember, I told you 3.2, it's 3.16 is the exact number. Their target is 2%. The PCE comes out in a couple weeks after that next one. But when we're looking, it comes out on January 26th. When you look at that, the monthly estimate that we're looking at that we think is going to be 0.1. So that's going to change. The 0.1 will replace the number from last year. So if we see these numbers, this is where we're seeing 0.1 and then in January, where that will be these first 3 months, because we think there's that bigger cut. And then if we get a little less, say it's, our estimate is not quite as aggressive for how much it's going to be cut. And we just go with a conservative number here. If you look at where that will take us, so if you take this is replacing the December number, the monthly estimate, here's the replacement number that we're thinking. If you take this 3.16 and the replacement, you subtract that, that's where we're going to be with PCE. If on the 26th, if these numbers come out here, we're thinking we'll be around this 2.87. Now, the feds have still said they want to be at 2%. So we're not quite there yet. That the next Fed meeting is January 31st. So likely the likelihood of them maybe changing that right away is a little bit lower because we're still higher than what their plan is. But if you look here at the following meetings and the forecast that we're seeing coming through with PCE in the following months, we're seeing by January, which is released in February, we'll be at 2.47. And then we should be going down to 2.21. And then even with these numbers here, I mean, look, you'll see by the time we get to May, we're really almost right on target. So what we're thinking is the likelihood of the feds cutting is probably a little bit lower in these few months, even though inflation is coming down and more substantially. By the time we get to this PCE number target that the feds are looking at or looking for, we'll probably be closer to the May numbers. So this is kind of our forecast and what we're looking at, but there are odds makers, just like when you're betting on football and stuff like that. Same thing when it comes to forecasting this kind of stuff. So the odds are also, or they're kind of along the same line. this 7%, then going into March, there's actually even up to a 68% chance that the feds may cut it. We're thinking maybe like just a quarter, but definitely by May, probably a quarter, or there's even a 56% chance of 50 bips. So just to kind of show you where this the odd makers are, there's different there's different over here. There's going to be Fed meeting, the Fed chair, the board, they have people that vote. And so the guess is for the people that are going to be voting, here's where that's looking like. So each of these dots represents one of the Fed members. This is all anonymous. This is their forecast, but where they're forecasting, two of them are saying no cuts. One is saying a quarter point. Now this is for the whole year. One is saying a quarter basis point cut. Where the bulk of them are is somewhere between 50 and 100 basis points. So between a half a point and a percentage of the Fed fund interest rate. So the likelihood is we're going to see about in this range somewhere. And then here's the good news. When you go into 2025 and 2026, the numbers of where they were thinking the rates are going to be are going to consistently are coming down. So really looking at the next 3 years, the trajectory of where likely the Fed's fund rate, which will still have an impact on mortgage rates, it's not a direct correlation, but it is a correlation. I mean, it just shows you that right now is the best time to buy, because really, if you can get in now, you can refinance over the next couple years. And even the Fed's fund members, I mean, the Fed's members, you can see are forecasting that they're going to be voting for rate decreases. So going into the balance sheet is the next thing that's going to really impact rates. So the balance sheet is where the Feds, where they own the mortgage-backed securities. So if you remember, they always own some of them, but if you remember in 2020, they were buying a ton of the mortgage-backed securities. That's why when this happened right here, that was when rates got crazy low all of a sudden, and the Feds were buying and buying and buying. Their balance sheet kept going up and up and up. The problem was that they didn't stop buying quick enough, and that's why we were in such a bad place, because inflation, this is what helped cause inflation. So right now, the Feds, they had peaked out at 8.5. This last year, they've been selling them off. Another reason why, rates have been a little tougher. But they've been selling them off, and they've gotten a little bit better, about $1.4 trillion better, but not quite to where they want to be. So looking at this, the Feds, where they really want to be, their target range is about here. So this is where we were between 2014 and 18, 4.2 trillion. And then when you even look, and the way it's they look at it still as a percentage, but the way you look at it is the GDP. So it was about 22% of the GDP. Right in pre-COVID, we were still at the 4.3. GDP was a little bit higher, so this number was a little bit lower. So as long as we're in this target, but then you can see when we peaked, when we were at that 8.5 trillion, our GDP was higher, but still this percentage was way too high, way higher than they wanted it to be. So that's why they started selling it off. So they needed it to go lower. So in January, right now, this is where we're at today. This has improved. So this is good. This is helpful. But if you kind of look at where we're going to be over the next several months, we see that with the forecast, I mean, some of these are a forecast that we're not sure of, but on the current trajectory of where they're selling off, if they keep on that path, where GDP is forecasted to be at, you can see here we're still higher than they want us to be. So we have these Fed meetings that we just talked about, and likely in March, we might see the first drop. May, we're for sure, from everything we can see, we'll have more drops. But then the question is gonna be, will they also sell off some? Will they try to reduce their balance sheet quicker to get back to where we really want it to be? Or will they kind of keep just, slowly down the path? But this is probably where we're gonna see potentially, if they did something, it would probably be around the back half of next year or of this year. So as we're in this back half time, we're also going to be approaching the election timing. There will be more pressure on the feds to likely get their balance sheet runoff more in line. So that's why we think that there is a likelihood, as we're kind of slowly moving down, that they may speed things up a little bit more to get to where that target really is. Now, if that happens, when they do that and allow that runoff, that's when we are usually in a recession. And there's a lot of indicating factors for recessions, but that was one of the biggest. So as you can see, anytime we're in a recession, interest rates go down every single time. So if that happens, then we're likely to see rates come down also from that even a little bit more. So in looking at our rate forecast for the year, the thought really right now is that during the year of 2024, we will be between mid-5 to high 6% interest rate. So right now we're kind of in the 6 range. But by the end of the year, likely is when we're going to be mid-5s. Under 6 should unlock the move up buyers. So as soon as we get below that 6% mark, that's when we're going to probably start to see a lot more people who were looking to move. They might be in a 2 or 3% interest rate now. Now that variant, because they're in the high 5s, isn't as painful, like when it was in the 7s and 8s. So that's probably when we're going to see even a lot more movement. So sometime in the back half of this year. The 10-year treasury right now, we're closer to this 4.4, but we're thinking we'll be in this range this year, getting down hopefully closer to 3%. And then that's going to get us into a more normal spread between the 10-year treasury, and where interest rates are. So this is kind of where we're thinking in the mortgage interest rate market is going to be. Next, we're going to dive into the real estate market. So as we look at real estate, it goes back to the same supply and demand. And when we're looking at demand for 2024, supply, it is tough. Inventory remains really tight. And this is, of course, nationally in Dallas, we are also seeing some of these big problems, and in some cases worse. So looking at that, we go off of supply and demand. And I've shown a lot of you this report before. You may have seen it in some of my past forecast videos, but this is household formations, which goes off of birth rates over the past 33 years, and home completions. Still, the builders are not catching up with the amount of demand with the household formations that we have. Last I had shown you was around where we were forecasting here, and that's pretty much where it came in. And it really going into 2024, we're not seeing much different here. So there will continually be this gap between how many households are being formed, showing the demand, and the supply of where new homes created. So we're going to keep running into that. So the other thing that I wanted to bring up is talking about affordability. You see it in the media all the time, and they're saying we can't sustain this. We can't keep having values go up like this It's just not affordable. Well, there's no doubt it is more difficult. It's for sure. Things have gotten less affordable. Housing has gotten less affordable. It's a larger percentage of our monthly income, but it's not really as bad as the media is claiming. So if we go back to 2021, and we look at a house where maybe the median, this is probably a little on the lower end, but a $240,000 home in 2021 at a 2.875 interest rate. So that's $1,000 for the monthly principal and interest portion of it. And the average monthly income here in this range would be at 4,000. That's what that's what it would take to qualify to be able to make this payment. So if we now come forward into where we are today, we say that same $240,000 home is 280, interest rate now to 6.625. That's $1,800. That's $800 more. That's not affordable. That's how the media is saying. But we haven't talked about income. Incomes have gone up. This 80% increase, an $800 a month increase in the monthly P&I, is not an 80% increase needed in monthly income. It's a 20% increase needed. So really, we are saying you need about 20% more income to offset this increase. Incomes have risen 15%. So overall, we know other things have increased too, and that's why we're saying we know that it is problematic, but it's not as bad because we've had increases. Incomes have risen 15% on average over the last couple of years, so since 2021. So our gap is now it's not as bad as media says, but if we look at it and we see where things are going over the next year with interest rates coming down, that will help still narrow this gap. Now, rate or prices could continue to go up, but hopefully with the rate that interest rates will be coming down, that's going to help offset this, so that with these incomes going up, it can be still a little more right in the affordable arena. So looking overall at the forecast for real estate, we're saying we think the national appreciation, and we have this from several different factors, and we can set up a call and I can show you where we got these too. But the national appreciation is probably going to be somewhere between 4.5% to 5%. But the transaction volume, that's going to be where we're really going to start to see a lot more movement here, is going to be 15 to 20% up. Because remember, we have the move up buyers most likely getting off the fence in the back half of the year. It's going to open up more inventory, cause more transactions. It'll get some more movement going. So between the appreciation going up 4.5% to 5% and the transaction volume up, we're thinking that 2024 is going to be a good year in real estate. We know we are coming off of a really difficult year, and those of us that are still in the business should hopefully reap the rewards of being able to be in this market and really getting to see it probably a great market over the next 3 years coming. So I hope this was helpful for you. I hope you found some value in it. Feel free to reach out if you want any slides specifically from me to share with your clients, or if you just want a one-on-one. But I hope you have an awesome real estate year this year. And I look forward to hopefully getting to talk to you sometime soon. Thanks so much.